Hello, welcome to the final part on ScarletToBlack's November topic of student debt. So this video is going to combine section 3 and 4. So it's going to go over paying off loans and also going over credit cards. And so we're going to discuss two main debt strategies. The first common one is to focus on paying off debt with the highest interest rate while also paying the minimum on other loans. And so after that, focus on the debt with the next highest interest rate while paying the minimum on other loans and so on. The second strategy is to pay off the smallest debt first while paying off other loan minimums. When that is paid off, roll the amount that you had been paying on it into payments on the next largest loan. And so that was quick. And so the next section is going to be over credit cards. And so to remember about credit cards is that credit should, again, not be thought of as free money. This can lead to an inability to pay back borrowed funds, and this can escalate very quickly. It can be quick to spend money on credit, but it takes a long time to pay it off. And so take the time to find the best credit card for you and your lifestyle. And the better your credit history is, the better interest rate you will be able to get on a credit card. And so a bit more about credit cards. What is a credit card? It's a card with a line of credit from the issuing bank. And so each purchase borrows money from the issuer. Borrowed money must then be paid in full at the end of the month in order to not accumulate interest. But how does a credit card work? And so once you're approved for a new credit card, you will be given a credit limit, which is just the maximum amount that you can borrow. You can pay a certain minimum amount, the whole balance, or in between when the bill comes. Only paying the minimum every month, however, can end up being very expensive, as this will lead to a high interest charge. Paying your bill in full is the least expensive option. By doing that, you get a grace period to avoid paying interest on the purchases you made during that month. And so how is your use of credit cards reported to the credit bureau? Your payments are reported to credit bureaus, which are the companies that repair credit reports. And the payment history counts for 35% of your credit score, which is the 3-digit number that indicates how risky it would be to lend you money. And to avoid late fees and harming your credit score, it's advisable to pay at least the minimum charge every month. And so there are different types of credit cards. And so one type is a rewards credit card. It's going to give you something back for each purchase you make, and it generally requires good credit. So a cash back rewards card, it gives you a small percentage of money back for every dollar you spend. An airline or hotel rewards card will give you miles or points that can be used to redeem free flights or discounted hotel stays. But keep in mind the dates of travel that rewards are offered in can be restricted. A general travel reward card will give you points that can be used to pay for travel expenses, and this is generally more flexible than branded airline or hotel card. A store rewards card is going to give you discounts or other benefits for shopping at a specific store that's provided by the card. Rewards cards are ideal for borrowers who pay their card in full every month, and the interest can counterbalance the reward if there is a balance on that card. And so types of credit cards, if you have average or bad credit. And so another thing to note is that credit can be hard to find with poor credit scores. Rewards are more limited and interest rates are higher. However, these certain types of cards, specifically for users with average or bad credit, can be used to build credit to qualify for a better credit offer later. And so for average credit, look for a card with either no annual fee or one with rewards and a small fee. If you have bad credit, look for a secured credit card. It's going to require a deposit that can be collected back after the card is closed or upgraded to an unsecured card. But it's the less expensive option for those with bad credit, because an unsecured credit card would require higher interest rates and fees sometimes with a security deposit. And in addition, with the unsecured card, that security deposit and fees will not be returned. Another type of credit card is a balance transfer. And so it requires good or excellent credit, and it allows the move of debt from one issuer to another to take advantage of a lower interest rate. Another type is a low interest credit card. No rewards are offered, and it provides lower interest rates, which means it is a less expensive in interest to carry a balance. You usually need good credit to qualify, and sometimes they come with a temporary 0% APR period, which could allow for one to pay off a singular large purchase. Lastly, another type of credit card is a student card. And so college students are not automatically qualified for these. Specifically, the Credit Card Act of 2009 prohibits issuers from giving cards to people under 21 unless they have proof of income or a cosigner. So do keep in mind that you do need either of those things. But when this is not an option, look towards a secured credit card to establish credit. And so to go over the pros and cons of credit cards, the pros are that you can build credit if payments are made on time. Credit is required for loans on housing, cards, etc. There are also ongoing rewards. If the right card is picked for your lifestyle, credit card rewards can be beneficial if you do pick a rewards credit card. The cons of this is that there are interest payments. These can accumulate quickly if you're not paying off your balance in full. There can be annual fees. There can be late payment fees. There can be balance transfer fees. There can be foreign transaction fees. So do keep in mind that those can accumulate very quickly. And so some tips for using credit cards: pay your bill on time and in full every month. It's advisable to keep your balance below 30% of available credit and wait 6 months between credit card applications. Review your account online every week to track your own spending and to avoid fraud, and keep a no annual credit card open if you do have one in order to avoid hurting your credit score. And so that's all for this month's topic.